So does that make sense, the difference between debt and credit? And so if you were to accrue a lot of debts, right, then you're going to owe a lot of money back. But if you had a lot of credit available to you and you don't use it, it's really no harm, no foul, right? Like it's available to you if you ever needed it, but again, you're not using it yet. So do you think there would ever be a time when there is such a thing as called good credit or good debt? If you were to buy something and you're like, you know what, that's a good debt. What might that be that would fit that category?
Something that's needed, like important. Like if you have to take out a loan in order to pay for like hospital bills for somebody else or something.
Yeah. Any ideas? Okay. So usually we consider good debts to be things that they may be required, like if you needed a car to be able to get back and forth to work and you needed to go out and purchase a vehicle, that could be a good debt. It could be a good debt that if you were to take out financial loans to go to college, right? Because that might give you the ability to earn more in the future and again, could be a good debt. So it's something that's going to give you more value in the future or allow you to do something that you can't today. There's definitely a lot of bad debts out there too, right? Things that we buy that maybe as soon as we purchase them, they are worth less than when we bought them. And so managing debt is very important, right? We want to make sure that we don't take on more debt than we can handle and that we have an ability to pay that off in the time frame that we want to pay it off, because the longer we accrue it, the more interest charges we're going to pay on those elements. Does that make sense? Good. Any questions so far? All right. Why would it be important potentially to have credit?
So that you could take out loans in the future?
Absolutely.
Or like buy a car?
Yeah, absolutely. So you could take out, so you'd have the ability to take on loans in the future, right? And so having credit available to you can be important because it can also help in like an emergency situation, right? You mentioned hospital bills. Something bad happens and even though we may have health coverage, that health coverage may not cover all the costs associated with being involved in an emergency type situation. So sometimes, if you have credit available to you, it can help in those kinds of situations as well. It can be really helpful when, you get to the point where you're ready to buy something larger, right? Like a car or a house. Many times that's the only way that people can purchase something of that size is to buy it with a loan and pay for that over a number of years. And generally with those types of loans, they're a little bit different than credit card loans because it's a fixed amount that you're borrowing and then it's a fixed payment until you pay that off. So you might pay $20,000 for the car and you might have to pay $400 a month for the next 5 years to pay that off. Does that make sense? And so that is a little bit easier to plan for and to manage than maybe a credit card would be. And the way that banks accrue interest on a fixed loan like that is that they generally accrue it once a month. And so you get one interest payment applied per month. Credit cards have a tendency to do that on a daily basis, so the interest accrues faster than it would if they only accrued it once a month. It's the same interest rate, it's just accrued differently, so the interest is much higher on a credit card. So if you have a choice of should I buy this with a credit card or should I buy this with a loan, many times the loan is going to be more cost effective than a credit card because of the way the interest accrues. Does that make sense? Good.
Credit card is called APR. They're probably going to go over all that.
Yeah, go ahead.
Really high, super high.
Yeah.
So as Jeff said, like if you can pay off what you put on your credit card at the end of each month when you get your bill, that's the best way to do it. Otherwise, you're going to pay so much more for all those purchases.
Yeah, it doesn't feel bad when you go and buy something for $100 and you put it on the card until you realize that I didn't pay that off for 2 or 3 months and that thing that I bought for $100 now cost me $140, right? So the interest adds up over time, and even though it's still attached to that one purchase, you're paying the interest charges on top of that, and it really does add up. Do you think that your credit could affect things like your ability to get a job? Yeah, absolutely, right? So especially in today's world, many employers are going to pull your credit rating to kind of understand how well you manage money. It can affect your ability to potentially to get an apartment or a house. And it also can extremely affect your ability to, how much you will pay for insurance, right? So could be car insurance, could be home insurance when you have a house someday. But they all pull credit ratings before they determine what rates you might pay. Does that make sense? Good. Let's see. Okay, so this is kind of a myth, and you tell me if this is a myth or if it's a reality. If you are worried about debt, you have too much debt. Do you think that's a myth or do you think it's a reality? Could be, right? But the reality in my mind is that if you have enough debt that you're worried about it, it's probably too much debt, right? And so definitely something that folks, they feel that every day in their lives, right? So, all right. So is there anything that you could do to potentially, let's say you wanted to go get a loan, is there anything that you could do that would help you ensure that you could get that loan? Anything coming to mind?
Does a down payment help?
Down payment would help, right? Have you ever heard of the word collateral? What does collateral mean? Collateral, so you've heard the word, right? Collateral is something that you could put up that says, if I don't pay the loan, then the bank could take that, right? Or they could use that as payment. So many times when we buy a car, the car becomes the collateral, right? So if you don't pay the loan the way you're supposed to, the bank can come back and what they say is called repossess the vehicle, right? Because technically the vehicle is still theirs until you pay the loan off. They allow you to use it. So they use that as the collateral. Sometimes, there's a lot of different things that you could use for collateral. It could be a vehicle like that. It could be you have an amount of money sitting in the savings. You don't want to use that amount of money to pay for the thing that you're buying, but it could become collateral that the bank could attach to. So that's a way that can help people sometimes be able to purchase things and a little bit bigger than they might otherwise be able to. Another thing that people can do is they could have someone co-sign the loan for them. So let's imagine that my credit isn't strong enough to be able to go out and buy a car yet today, but my parents have strong credit and they agree to co-sign the loan for me. Do you have an idea what that might mean for them if they co-sign the loan with you?
They would have to help you.
Right. So what it really means is that they're also on the hook that if you don't pay the loan the way you're supposed to, then the bank can then go after whoever the co-signer is, right? Generally, many times that's a relative, but it doesn't always have to be, right? So that co-signer can also allow, because of their credit, can help people, especially when they're first starting out, to be able to get a loan of some sort. Does that make sense? Good. So we've talked about a few different types of loans, right? We talked about credit cards and how they work, and we've talked about consumer loans. So those would be things like a mortgage or a car loan, right? And so I think we've pretty much hit all of the things that are important there. If we talk about a consumer loan, so like a car loan, generally that would be set up so that the payment occurs at the same time every month, right? So let's imagine that on the 5th of the month, I've got to pay that $400 car loan bill, right? Generally, they will give you a grace period that says, maybe we'll give you another 10 days. If you haven't paid it in 10 days, we're probably going to hit you with a late fee, right? And a late fee can be $10, it could be $40, depending on the bank and the type of loan that it's in. And if you're consistently late, then they can add charges on top of that. So again, it kind of goes back to that point of wanting to make sure that you stay current on your loans or your debts, because those fees and things can add up pretty. So when we talk about loans and interest rates, are there different types of interest rates that might be important? What would be important about different types of interest rates? So there's fixed rate loans, right? A fixed rate loan means is that the interest rate always stays the same for the life of the loan. Generally, again, these are for things like cars, homes, that sort of thing. So the interest rate might be 4%, and that 4% is going to be for the entire life of the loan. Whereas credit cards have an ability to change the interest rate, and it's called variable interest rate, right? Based on what the current interest environment is doing, right? So when you hear on the news that they're getting ready to raise interest rates, well, what that means is that as banks raise their interest rates, generally that flows through to credit cards, and those rates are going to go up. So it's not a fixed rate every month. And again, it's important to make sure you understand the terms of a credit card and know what the ranges of those interest rates might be. With a credit card, if you're late, generally they can put you into a penalty interest rate that's also applicable. And so you might go from an interest rate, let's say that's 10%. And if you are late a couple of months, they may push you into an interest rate that's like 30% because they don't trust that you're going to be able to pay it on time. You haven't shown them that history. And then after a certain time period, if you are consistently on time, then you sometimes you can get it lowered back down again after a certain amount of time. So again, it just goes back to show that they really want you to be on time and how you pay these loans and debts. Make sense? Good. All right, so this is kind of an easy one. We talked about this a little bit, right? But co-signing a loan may affect your ability as the co-signer to get a loan. Do you think that's real, or do you think that's a myth? So a co-signer of a loan, if I'm a co-signer, it may affect my future ability to get another loan. You think that's real or a myth? Yeah, it's real, right? Absolutely. Because, yeah, absolutely. You guys can grab a piece. Because the loan, you are technically on that loan, right? And so as a co-signer, even though I may not be paying the loan off, it will hit on my credit report as being part of something that I'm responsible for. So it absolutely could affect my ability in the future. Okay, so let's skip here a few. So do you think there are any barriers that could prevent you from being able to borrow money? We've talked about a few of these, but just talk about them specifically. Anything that could make it difficult for you to potentially borrow money or get a loan?
I think one major one would probably be not paying back stuff that you have to.
Yeah, absolutely.
Put in a large amount of debt.
Absolutely. Like making payments late could absolutely affect our ability to borrow in the future. Have you ever heard of the term bankruptcy? What is bankruptcy? Yeah, so if you have accrued so much debt and you just really do not have an ability to pay that back, you can file what's called bankruptcy, and you can get some relief from the creditors for the debts that you owed. Sometimes they will wash them completely away. Sometimes they will negotiate different terms to be able to extinguish those debts. But bankruptcy is something that hangs on in your credit report for a very long time, generally 7 to 10 years, right? So a bankruptcy is something that will, if you had even a reasonable credit rating, a bankruptcy is going to drive it significantly lower, right? And so that would definitely be a big barrier in the future until that bankruptcy starts to come off of your record. then it becomes a little bit easier. If you have a property that's repossessed, yeah, question.
So I've seen this a lot on like different TV shows,
Yeah.
I guess. But like, are loan sharks, like, do they still exist nowadays?
Yeah, so the question is, do loan sharks exist? And the reality is that yes, they exist. They come in a lot of different colors, though, right? And so what we would consider loan sharks could be folks that are willing to loan money at a very high interest rate, right? And then are going to expect that payment back, right? And so, not that payday loan companies are loan sharks, right? But they kind of work under the same principle of they know you need the money, and so you take them a check that you might not get paid. Like right now is tax time, right? People may know that they're getting a refund in 2 or 3 weeks, so they could go to one of these companies and say, "I want my refund now." That company would loan them the money that they would have gotten from the refund in the future for an interest rate. And when they get their actual refund, when I get the refund, I have to then go in and take that money plus the interest for that amount, right? And so not necessarily a loan shark, but the same principles apply, right? And so they definitely exist out there. So you guys remember what repossessed means when we talked about that? I mentioned that a few minutes ago. Right. So you had something, you didn't make the payments, and the bank or whoever came and took that back. That's called repossessing it. There's also something called foreclosure. And so foreclosure is generally more for homes. So if you'd bought a home and you weren't making the payments for that home, foreclosure essentially is a process for the bank to repossess that house and physically make you leave the property, right? And so it behaves very much like a repossession. The other thing that can make it really difficult for borrowing money is if you have a court order that comes down that requires you to pay money somewhere, right? So imagine that I was driving the car and I injured someone out on the street. They sued me, and the court ordered that I have to pay this family back, right, for an injury or something. Then that can also, if I'm not diligent in paying that back, that can also influence my ability to borrow in the future, because it is exactly like having a loan, but it's just implied by the court instead of a banking institution. Does that make sense? Good. Okay, so we've talked about all those. So you mentioned credit report earlier. Let's talk about what a credit report is. What do you think a credit report is?
Reporting past credit of like the money they get.
So maybe a kind of a history of how we've used credit. Yeah, I think that's good. Any other thoughts?
A way the bank and institutions of knowing how you are with your credit history.
Yeah, absolutely. So that's exactly what it is, right? As a way for banks and other financial institutions to understand what your history has been and how you manage money. There are 3 credit reporting agencies that are out there, and as consumers, we have an ability to go out and check those credit reports anytime we want. You get a free credit report once a year from each of those 3 entities. And it's important to check our credit report because sometimes things might get misreported on there. There may be things on there that aren't even associated with you. Maybe someone else has accidentally put something on your credit report that doesn't apply to you. You can also use it to try to track if someone else maybe is taking credit out in your name. So it's very important for you to always check your credit reports on a regular frequency and just make sure that all the information that's on there is accurate, because that is what companies are going to use to try to assess whether you're worthy and how much interest you might have to pay for a certain loan. So what do you think the key things are that go into a credit rating.
How you pay it back.
Yep. So how you pay it back? Are you on time? Absolutely. Anything else that you think that they pay attention to when they give you a credit rating? Yeah, so there's a handful of things, right? Like, so the biggest one is absolutely, are you on time, right? Because they want to know, are you paying things the way you're supposed to? Another really big one is how much of the available credit that you have to you are you consuming? So let's imagine you had $1,000 of credit on a credit card. If you're at $990 of that 1,000 that you've already spent, then they're going to view that as not very good, right? But if you're at $200 of that 1,000, then they're going to view that as much better, right? And as you get more credit available to you, it becomes a bigger deal. And what I would say is there's kind of a sweet spot. They want to see us using the credits available to us to some extent. They don't want us to see us overuse it, right? So generally, if we're consuming somewhere between 20 and 30% of the total available credit that's available to us, they generally view that as optimal. The other side of that is if I have all this credit and I don't ever use it, then they actually start to view that as negative as well, right? So those are the two biggest things. Do we have any negative marks? I would use that term against us financially, right? Has any creditor, are they saying that we're not paying or that we are delinquent on anything? That's another thing that will go into our credit rating, right? So those are kind of the biggest things. Questions or thoughts on that? Do you know what the range of credit ratings are? It's a really odd range.
It is.
It's from 0 to 850, right? So 850 is like a perfect credit rating. What I would tell you is that if you are 750 or 760 and above, that's going to be the highest credit rating scores. And then there are tiers below that are going to get attributed different ratings, right? Like different quality. And depending on where you are in that range is what the bank's going to use to say, oh, okay, their credit rating is at 840. They're going to get our best rates available. If we're at 500, and this is the other piece, the scale decreases very quickly. So if you are 600 and below, it's really considered like you have pretty poor credit history, right? So it's ideal if we can keep that in the high 6s to 7s to low 8s is really where we want that to maintain. The higher in that range we are, then the better off we'll be when it comes to borrowing stuff. Does that make sense? Questions or thoughts on that? Okay. Okay, so let's imagine that a debt collector is calling you about repayment of a debt. Do you have the right to tell them to stop calling you?
No, because you owe them.
You actually do have the right to tell them to stop calling you. It doesn't mean that the debt, you don't still owe the debt, right? You still owe the debt, and they will still report the fact that you are not maybe on time, but you do have the ability to tell them to stop calling. And sometimes they can call 4 or 5 times a day trying to get a hold of you, right? And it can become problematic, right? So you do have an ability to tell them to stop. Right? All right, so let's talk about predatory lending practices, right? How do we guard against maybe people that are trying to, in that loan shark kind of venue, right? How do we deal with that? How do we try to stay away from that? Well, the first thing would be we always want to deal with a trusted lender, right? Somebody that we know, we've heard of, maybe somebody else has used, right? Yeah, absolutely. Good feedback. And there, each financial institution gets rated as well, right? So you can go out on the internet and do some research on how are they with customer service? How well do they deal with people? That kind of stuff. The second thing I would say is that you always want to shop around for different rates because when you go, let's imagine you're going to buy a car. Well, the car dealership generally has preferred relationships with certain banks. So they'll be like, oh, I can get you a loan for that. And they can, but it may not be the best loan that you could get, right? So it might be the best loan that they can provide. So many times, it might be good to just calibrate the loan that they're offering you versus the bank that you use or another bank that you trust, right? Say, hey, I'm at this dealership. They've offered me X as the interest rate, and these are the terms, and just validate that what they're offering you is the best that they can get. You want to make sure you read and understand any terms and conditions that are associated with a loan, right? And many times that's not going to be easy because there's going to be a lot of information in there that maybe doesn't make sense to you. And it might be important to bring somebody with you that does maybe understand that better as well. Yep, absolutely. And then the last thing, right, is you want to make sure that you can afford and make the payments of whatever the loan terms are requesting, right, or required. Unfortunately, in today's world, there's a lot of folks that don't do that as well as they should, and then they get themselves into a situation where they don't have enough cash flow to be able to support the loans that they've taken out. Good? All right, so we've talked about loans, we've talked about credit cards. There's some other things that are out there that you could be used as well to help with certain things, right? Have you guys ever heard of rent-to-own services?
We have a house in Atlanta that's rent to own, so does it mean that you could start out renting it and then later on in the renting process you could buy it, potentially?
Absolutely, right? So that's a great example. So the example was a home, we're renting it in the beginning with the option to purchase it in the future. I'll even make it a little bit simpler. Imagine you wanted to get a new TV, and there are rent-to-own companies where you can go rent a TV, put it in the house, and there's a time period where you're going to pay them back. Again, the company that gave it to you still owns it, but as you make payments over time, you begin to take ownership, and then when it's paid off, it is yours. Now, those do come with interest rates as well, right? But again, just another way of using those types of services. We talked about payday loans, right? And refund anticipation loans earlier. So those things are out there as well. Imagine you were working and you get paid every other Friday, or even worse, maybe you only get paid once a month, right? And you just didn't have enough money to make it that last week of the month or the last couple of weeks. You could go to a payday loan service, show them your paychecks, and they will give you an advance of the money that you would get when you do get paid for a fee and for an interest rate. So, and generally those terms are very high and very expensive. So you want to try to avoid them if you can, but just know that they are out there and what they do, right? Questions or thoughts on that? Okay. All right, let's see.
Jeff, with some other considerations, could you tell them how you can lower your potential monthly costs for paying a loan by having a down payment? What that means?
Yeah, absolutely. So again, we'll use a car because that's an easy way to use it, right? So let's imagine the car costs $20,000 and the bank was like, well, we can give you the full loan if that's what you want, but the interest rate's going to be 5%. And maybe the payment would be $500 a month, right? For 5 years. But if you brought $4,000 to the table and said, I want to put a $4,000 down payment, the bank many times will give you a lesser interest rate because now you're not borrowing as much and you've brought something to the table. So now instead of 5%, maybe we're getting it 4%. And now the loan, instead of being $500 a month, because we've already bought a portion of the car, is now only $400 a month. So a down payment is a huge advantage to help us maybe purchase something that would help it keep it within our monthly budget more appropriately, right? And again, we talked a couple of sessions ago about having an emergency savings fund, right? And so having dollars set aside could be something ideal for like a down payment. Good question.
So what's the range of an interest rate, like considering like by 1%, I guess?
That's a great question.
Yeah, so interest rates can be all over the place, and it depends on what you're buying, right? As we talked earlier, credit card interest rates can be everywhere from 0%. I've seen them as high as 35, 36%, right? I mean, and that's a very high interest rate. Fixed rate loans are generally less. I would say, depending on what we're buying and what our credit is, I would say fixed rate loans are generally somewhere between 3 to, I don't know, maybe 10, 11, 12%, somewhere in that range. Again, depending on our credit, it could be potentially higher, but fixed rate loans tend to be less than credit cards for sure. Does that answer your question?
Somewhat.
Okay.
Dealerships, just kind of going, to Jeff's point, they'll have their own deals because they'll finance with a bank and loan you money so you can purchase a car. They will run specials sometimes, so they'll have special interest rates. Like right now at a Honda dealership, it's maybe 1.9%,
Yep.
like that, which is a lot better than a 25% interest rate on a credit card.
So imagine this. Why would a dealership offer 0% interest for a loan? So you wanted to buy a car, $20,000 car, and their deal at the time is we'll give you 0% interest for that. Why? What is their incentive to offer you a loan at 0%?
So that you would, there's a higher chance of you buying it?
That's one thing, right? They want you to buy it at their place for sure. Anything else? Any other reason why they might offer you 0%?
Maybe a bit more motivation to get it done on time.
Yeah, absolutely. It could help you, it could help maybe you buy a bigger vehicle than maybe what you intended. It could, generally, loans aren't free, even though they're 0%. There's fees associated with that loan. And many times dealerships will offer loans like that with their preferred lender because they're going to maybe get a finder fee, right? If I bring you to them to get a loan, I'm going to get a fee back, right? So many times there's a lot of relationships like that, again, it's not bad for you, right? Because you're getting a great interest rate, but it allows them to potentially sell a little bit nicer vehicle and they generally will get some sort of a kickback out of that loan. So, yeah.
I've had companies offer me no interest rate on a loan for like up to 2 years.
Yep.
But if you don't pay it off by the end of the 2 years, not only will you owe what the current interest rate is, but you'll owe it for that full 2 years. So it really pays to pay it off on time.
Absolutely. And a good example of that is like Lowe's Home Improvement does that, right? Rooms to Go is a furniture company, and they will give you no interest for like 3 or 4 years if you wanted to go buy furniture there. But it's exactly the same thing. If you don't pay the amount that's due by the time period that is due, right? When that time period finishes, then it's going to, all that back interest that was deferred is now going to show up and be owed. That is a great point. And so that's another kind of, in my mind, a little bit predatory lending practice to just keep an eye out and understand, right? Because again, there's nothing free in this world.
No.
So you always got to read the fine print of what those terms mean, right? When we go back to that.
Can I tell something?
Yeah, absolutely.
So, when I first graduated from college and I started working for a loan company, and I was only there a short time because I really didn't like how the practice worked. And what they did was people, to Jeff's point, would come in and get loans with these very high interest rates because these were people who had really bad credit. And I saw people that worked really hard to pay off talk to them, take them back to his office, and convince them to take out another loan. And I was like, no, like, stop. Anyway, so I didn't stay there. But it's almost like a cycle that some of these predatory
Yeah.
type of lending firms will do. They'll convince you that you want to buy something else, they can loan you money. And it's cyclical. So to Jeff's point, it's really good to look at all your options and figure out, based on the terms, like how long it's going to take to pay it off, how much the interest rate is, and all of that, like what is the best way to go.
Yeah. So we talked about credit scores a little bit ago. Do you think that it affects your credit score if you check your credit score? Yeah, it's a myth that a lot of people believe that if you check your credit score too often, that it's going to actually make your credit score go down. That's actually not true. You're not affecting it. Now, if other people are checking your credit, right? So like you apply for a credit card, they're going to go out and check your credit score. That actually does impact your credit score. So if you're out there applying for a lot of credit in a lot of different locations, that is going to make your credit score go down, because they keep track of how many times are you requesting credit from other institutions, right? So that, again, a little bit different than you checking your own credit, but just to be aware that if you're applying for a lot of stuff, it will affect your credit score.
Jeff, can you talk to them about what it means to freeze your credit?
Yeah, absolutely. So great question is around freezing credit, right? So if you, well, and there's a couple situations here, right? So imagine you think that someone has your personal information and may be trying to take credit out in your name. You can call the credit agencies and freeze your credit in a way that nobody can take anything else out in your name without specific actions taken by you, right? Go ahead.
So it's like the same as what you talked about last time with freezing your bank account. or something.
Absolutely. It's very much like freezing your bank account.
Use Katie for that.
That's right.
Really good.
And it's important because many people don't understand that they have an ability to freeze their credit in that way, right? And so it's important that if you ever see anything suspicious in your credit report, that is an action that you could potentially take to protect yourself from anybody else being able to take anything out in your name. Good question. Let's see here. Yeah.
Take your credit instead of like from bank account?
I would say it depends, right? It depends on how frugal you are with the information that you provide, right? In today's world, the internet makes it really easy for us to put our personal information into places that might be accessible to folks that want to do bad things with it, right? So we really got to be diligent in making sure we're only putting that information in places that we trust. And sometimes that can be difficult. Sometimes you can get, like we talked about phishing emails last time, right? Sometimes you can get an email that looks like it's coming from the bank, and you click their link and it takes you to a website that looks like it's the bank, but it's really not, right? So it's important to understand that, like, a bank would never ask us for information via email, or for you to provide things to them via email. In that instance, I would call the bank and say, hey, I got this email. It's asking for this information. Is this correct, right? It's a way to kind of validate that. Sometimes they may need that information, but usually they're not going to ask it via a method like that.
Isn't typically the method the way you calling? Just because it's more direct.
Yeah.
There's probably a way it can get out.
Right. Yep, absolutely. Okay, so another question. It's not uncommon for people to have more than one credit score. Do you think that's a myth, or do you think that's real?
It might be real.
Yeah, right. We talked about the 3 different credit reporting agencies, right? So it's very real that you could have each one of them might view your credit history slightly differently and be able to give you a rating. All right. We talked about the difference between credit cards and ATM cards the last time, right? So I'm not going to spend time on that again. Student credit cards, slightly different than a regular credit card, right? But many times banks will give more favorable loans to students. So like if you're in college or taking classes, they'll give you generally a lower credit limit. They will generally give you a better interest rate because they know that people are trying to establish their credit, but it's still important that you follow the same fundamentals of not overusing it and being on time, right? Because that's what's going to be able to help you build the credit over time when you're ready to do bigger credit discussion things. Rewards cards. Do you guys know what a rewards card might be? If we talk about a rewards credit card.
Like like this is like when you don't really have to pay them, or like just don't. I do know that you get like little cards that you like if you stay up or going there, you get a free one after a certain amount of time.
Right, right. So that's a very simple, but credit cards do that too, right? Credit cards might offer airline miles where if you use their card enough, you can get a free airline ticket, right? They can give you cash back. Some cards, I'm sure you guys, if you watch television at all, you see the Capital One cash back cards. They're all over the place where they're talking about what's in your wallet, right? And they're primarily, the more you use it, then they will give you some of that cash back. Generally 1 to 2.5%, maybe, depending on the card. But if it's something that you're good at using the card and paying that off, then you can accrue some value by using it that way, right? That's a smart way to use a rewards card. Or if you know you like to travel, or like the flight miles, if you like to travel, then you could use one of the airlines cards and accrue miles that would eventually allow you to have free plane tickets to go different places. So there's a lot of rewards cards out there. And if there's something that you are really excited about, then I'm sure there's a rewards program out there that you could use that for. But again, it's about being smart with it and being consistently paying that off over time. Okay, so in 2008, what percentage of undergraduates, so that would be people that were in college, do you think had at least one credit card? Yeah, so if you were to put a percentage on most, what would that be? Just a wild guess.
I would say 95%.
Yeah, 84%. So that's a big number, right? For college kids. Only 17% of those undergraduates paid off all their credit card balances each month. So that's a large number of people that were carrying a balance, right? So just, everybody understands the fundamentals, but it's hard. A lot of people don't live that way, right? And on average, college seniors were graduating with an average balance on credit cards of about $4,100 when they would graduate from college. So pretty interesting numbers, I think. Questions or thoughts about that? Yeah.
It's not about the college thing, but yeah, I found a question.
That's all right. It'll come back. So, especially as you become an adult, you're going to get lots of credit card solicitations in the mail. Lots. And it's important that, one, I always open every credit card solicitation that I get, and I shred them because I don't want that to go in the trash and then somebody else find that and then they could use that information and get a credit card in my name, right? So I tend to open all those pieces of mail and shred them. Obviously, you can look at them and see what they're offering and see if it makes sense, but as you become an adult, you're going to get tons of them, and just know that most of them probably aren't of value to you.
So if you use a credit card, right, and if you don't use it for a certain amount of time, do you still get a bill? If you don't?
Yeah. You'll still get a bill every month if there's a balance, right? If there's no balance, you may go months where they won't send you a bill. And that's okay. And there may be, if you don't use a credit card for a long period of time, say 6, 8, 10 months, they may start to lower your credit available to you, right? So let's say you started with $1,000, and if you're not using it, they may make it $800 then, right? They'll always let you know that they're going to reduce it. Or if they see that you're using credit very well, then they may increase it also, right? So if you started at $1,000 and they see you're doing really well with it, you may get a letter in the mail that says, because of your good credit history, we're going to now make your upper limit $1,500, right? So it kind of works both ways. But yeah, good question. You may get offers when you get those solicitations that on the front of it, it's going to say pre-approved, right? Well, pre-approved doesn't necessarily mean that you are guaranteed, right? They're still going to run your credit history and they're still going to make an assessment about you, but pre-approved means that you have the right demographics for what they're looking for in a credit card holder, right? So again, doesn't mean guaranteed.
So pre-approved just gives you a possibility.
Yes, it's a possibility, that's right. Now, I'll use pre-approved in a little bit different terms, is that if I were looking to buy a house, it's a very positive thing to get pre-approved if I wanted to buy a house. Because what that means is that I've gone to the bank has reviewed my credit history, and they've said I am pre-approved to be able to purchase a house up to a certain level, right? And that can be very helpful when you are ready to buy a house, because then you already know what you can or can't buy. So a little bit different term, but same term, a little different usage. We talked about grace period, right? And that's the time that the bank gives you to be able to pay. And we talked about some of the different fees, right? Some credit cards might charge you an annual fee just to be able to carry their card. We talked about late fees if we don't pay on time. Sometimes credit cards may allow you to go over your limit, and then when you go over your limit, they'll charge you a fee for having gone over your limit. Balance transfer. So let's say you had 2 credit cards and you wanted to move the balance from one credit card at a higher interest rate to another credit card of a lower interest rate. Sometimes they will charge you a balance transfer fee, right? So it'll cost some money to be able to do that. Some credit cards allow you to take money cash out. So you could go to an ATM and put your credit card in and pull cash out. Many times they're also going to charge you a cash withdrawal fee for doing that. Those are usually most of the fees associated with that. Any questions or thoughts on those? Good. Let's see. I think we've covered just about everything.
Any more questions?
Yeah.
For Candy?
She's trying to get credit card.
All right, here's another one. Whether this is a fact or a myth. Always close credit card accounts that you do not regularly use. Keeping them open hurts your credit score.
I believe it could be part of reality because if you don't use it, it can affect your credit score, whether you know it or not.
Yeah, so it's actually a myth, because if you have that credit available to you and you're not using it, if you remember, we talked about how they score us, right? What's the amount of the available credit that we're using? It actually doesn't hurt us if we have that extra buffer in there, right? So if we had a $1,000 credit card that we weren't using, then that's $1,000 that goes into that calculation and doesn't actually hurt us. So Yeah, it doesn't really affect our credit score. Now, if we close the account and that amount comes off of our available credit, right? So let's imagine we had 3 credit cards and they were all $1,000 limits. On 2 of those cards, we had $750 on each of them, right? So $1,500 out of $3,000 on all 3 cards really isn't that bad. But if I close the one card because I'm not using it, now I'm $1,500 out of $2,000. You can see how that would affect my credit score. Now it looks like I'm using way more of my credit available than what I should be. So sometimes closing an account can actually negatively impact your credit. So yeah, if you have more than one. Yep. All right, one more. About 1 in 10 U.S. consumers are considered credit invisible. First question is, what is credit invisible?
They don't have any credit.
That's exactly right? Like they have not established any credit whatsoever.
So 1 in 10.
So then the question becomes, is that real or is it a myth? So 1 in 10,
I think it's real too.
10% of 20, so that's 26 million people in the United States that are credit invisible, that have no credit at all.
Would that be considering some teenagers and some adults?
I think this is considering all adults because, until you become an adult, they really don't start tracking your credit history.
I mean, it makes sense because I know like some people have their own mindset. Like, I don't want to get a credit card because I know that I'm probably not going to be able to pay it back.
Yeah. But that's why it's important, even, as you become an adult, it's important to start a process of establishing credit because many times most of us are going to need to use credit at some point in our life, right? Whether it's to buy a house or a car. It would be great if we never had to, if we were just diligent savers and could pay cash for all those things. But the reality of that is pretty tough in today's world. Good. Questions, thoughts, comments?
This is awesome. Do you guys have any other questions for Bill?
How'd you feel like the information was today? Pretty relevant?
I think you guys deserve another piece of candy because you were both so amazing.
Absolutely, I agree.
You were awesome.
Oh, one thing.
Yeah.
Can you say, like, you said predatory, but I'm going to say predatory institute because, what did you exactly mean by that? Because I know, like, some of them will try to negotiate you back into a different loan with different statistics.
Yeah, so predatory in my mind is more like they're taking advantage of people, right? In a way that by charging really high interest rates, they know that those people don't have maybe other options or that they've painted themselves into a corner for different reasons. And so, that's what I mean by that term, is that they're taking advantage of people. And most reputable banks don't behave that way. Does that make sense?
Yeah.
Yeah.
Thank you.
Yeah, absolutely. It was good to see you guys again today.